We have another up day in stocks, even as the dollar and bonds take a breath to think about things in the wake of the huge reaction that we got in the financial markets following the result of the US presidential election. And arguably, because that result came quickly and was not drawn out, we have missed a bit of something, though. We're not alone. It seems like the market was so focused on what was going to happen in that election that they weren't really paying attention to economic data coming out of China that might be signaling something of a sea change in the works. That's what we're going to focus on here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We're going to break down what you might have missed about economic developments in the world's second largest economy over the past couple of days, how that might impact things going forward, and in fact, how it is already impacting them, but also the trading opportunity that might be taking shape as these headlines come across the wires and the markets respond to them. So let's first take a look at what we've seen here overnight. This is ASHR. It's an ETF that's tracking China's benchmark CSI 300 index. It is essentially China's version of the S&P 500. This is going to track the biggest listings both on the exchange in Shenzhen and in Shanghai. And you can see here a potent rise in those markets over the past day, which is an interesting thing to consider because, of course, the expectation might be that the exact opposite should be going on. We've just had Donald Trump win a resounding victory in the U.S. presidential election. Both candidates were China hawks, as it were. Both of them favored a more assertive stance, certainly not a loosening one. And the resounding victory for Mr. Trump seems to suggest that voters very clearly wanted the more muscular, the more assertive, the more combative version of the China hawk stance of the two candidates. So it seems a bit strange, perhaps at face value, that you have this very strong rise in Chinese stocks, even as the candidate that's going to take up residence in the White House next year promises more of a trade war footing, promises more tariffs, and promises to single out China for higher tariffs than elsewhere. Nevertheless, the ASHR here surging as the underlying index posts a rise of 3%. That's the biggest increase it has seen in essentially 2 weeks' time, 3 weeks' time. October 18th was the last time anything comparable occurred. So we're looking here at significant optimism, confirmed as well in copper, a sort of famously sensitive commodity to China's business cycle. China, of course, the world's largest buyer of copper. And so if there were, in fact, some sort of a positive development for China's business cycle, then perhaps you would expect both stocks and copper to move. But because Chinese stocks can often be inspired by decree from Beijing, that you see confirmation of their move in what is a broadly traded, liquid, open on the markets commodity, that gives credence that the move isn't just a flash in the pan or an official's dictum, but rather something that reflects genuine market optimism about what's going on. So why is it that we have this kind of a thing? And the answer seems very clearly economic green shoots. This is the import-export data that came out of China this week. And what we see here is very clearly a strong pickup in exports. You see that right here. Imports, of course, continue to be anemic, so domestic demand not exactly sending the best of signals, but also not really deviating from the range where it has sat for the past several months, and really the range that's been carved out here since the beginning of the year. We're just about within that coil, but exports here clearly booming. As a matter of fact, we saw a rise of over 12% in exports here. That amounted to the biggest year-on-year increase since July of 2022. So, needless to say, a very strong sort of picture here for Chinese exports that speaks to exactly the kind of demand that the beleaguered economy might hope to see were it to begin to recover from its long malaise after it lifted zero COVID restrictions belatedly, and really has struggled to find its footing ever since. Just a mere day earlier, we got a slight hint at essentially the same story from the Caixin and S&P Global Purchasing Manager Index data. Now, there's an interesting thing in China where you get, much like the US, the domestically formed version of this data, and then the S&P Global version. S&P Global tends to be the main provider of PMI data for most economies, but some of them do their own or have a rival set. In the U.S., we have the S&P Global numbers as well as those from the Institute of Supply Management. In China, we have official numbers from the China Federation for Logistics and Purchasing, CFLP, and then we have these numbers, which are from S&P Global, the main international provider, in conjunction with Caixin, which is a media company. And what we see here is a very interesting pickup in both manufacturing and services. Now, manufacturing still basically at standstill. The way these numbers work is they have a center axis at 50, where that's neutral. That's neither growth nor expansion, or growth nor contraction, rather, of economic activity in the relevant sector, services or manufacturing. And what you see here is that manufacturing then is hugging that 50 line. So having decelerated here from about May, it is essentially holding a little bit above, a little bit below 50, depending on where you look in recent months, and is essentially hovering at no movement, at standstill. Services, on the other hand, post a very strong rise here. And what this boils down to as a composite number is the strongest pace of economic activity growth in China in 4 months. Now, where we find a bit of confirmation for the export side of the story here, or at least the driving emphasis on that as the reason why things in China are doing what they're doing, if we turn to that report, we see it cites another solid rise in export orders and sort of cheekily hints that this speaks to rising interest from foreign markets, such as the US. Now, one might wonder how it is that we have a pickup in economic activity and a surge in exports, ostensibly because of a rise in interest in foreign demand, notably the US, when the US is at the forefront of a trade war that looks likely to escalate now that the relatively softer version of it under the Biden administration, which would be probably continued were we to have a President Harris next, is likely to transform into the more combative version, which we saw obviously begin in 2016 under the prior Trump administration, and that by all accounts, has every reason to return, listening to the president-elect himself, in the second administration. What's more interesting still is that official figures out of China for the same period for October are not nearly as rosy. They're actually at standstill. As we can see, both official PMI and service sector, the service sector activity index are essentially at the 50 level. So they're basically stuck and have basically gotten here since this reopening post-COVID. So the zero COVID restrictions come away right here. We can see there's a surge in services activity, manufacturing perks up. It lasts for a grand total of between 2 and 3 months, depending on whether you look at manufacturing or services. And then things turn sour and they never come back. We get down into standstill and sit there. Now, the frequent refrain is that Chinese economic data is massaged in order to look better than it is. This is the opposite story. These are the official numbers, which tell a more dire, a more anemic story than do these Caixin ones, which tell us that things are actually getting a little bit perkier here. So is this then a reason to celebrate? Well, the market certainly seemed to think so, looking at their initial reaction, but does that make sense? Perhaps not. Perhaps the focus on exports here is the tell. If the markets know, and if businesses know that the tariff environment, the tariff status quo, is about to become much more restrictive, that trade barriers are about to rise much more emphatically, then you would expect that businesses would try to front run that. They would expect higher costs downwind, because of course it is importers of Chinese goods that pay tariffs, not China. One government can't exactly compel another to pay it a tax, but it can certainly compel its own domestic companies importing Chinese goods to pay a tax in order to import it, which is, of course, exactly how tariffs work. So companies, for example, in the US that foresee downwind higher tariffs and a generally more combative trading environment with China would be well served to buy as much and to build as big of an inventory of Chinese goods now as they can before those costs go up. So the pickup in export growth here doesn't actually tell a story of resounding strength, does not tell a story of returning demand that can be extrapolated further, but rather seems to be more about front running before things transition into much darker times. That is, if you're an importer of Chinese goods or an exporter in China feeding that demand. That, of course, does not bode well for the general anemic state of China's economy, where now for 6 consecutive quarters, there is economy-wide deflation. We see here in the red is real GDP, in the yellow is nominal GDP, which is supposed to be the rate of economic output creation, as it were, including inflation. Real GDP is supposed to strip the inflation component out and get to just the output. Well, if the real one is above the nominal one, that means that what we're doing when we're subtracting inflation from nominal growth is we're subtracting a negative number, which means inflation here is negative. And at the GDP level, this speaks to economy-wide deflation to the tune of nearly a percentage point of GDP growth on average over the past 6 quarters. And so what we're looking then at when we consider these numbers is just in very simple terms, an economy without demand. The price for things goes up when there is demand because people that want things compete to get them, and that bids up the price. If the price is going down, the opposite is occurring. Nobody wants things, and so the entire economy is effectively on discount to try to engender demand. We might get a picture of just how fleeting all of this looks when we consider the numbers due over the weekend, where we're going to get Chinese inflation figures, and in particular, the consumer price index, which we can see here really speaks to just how anemic demand is, hugging the zero line. For wholesale prices, things are even worse. They've been in deflation mode since essentially the middle of 2022 and have recently taken a turn for the worst, implying that even in the pipeline, demand is not strengthening, but rather weakening. And so when we consider these numbers, they might very well be a helpful way to look at what comes next. The expectation, incidentally, is that we are going to get PPI slightly less negative, down 2.5% for October when these numbers come across the wires. And the headline inflation rate will continue, the consumer price index will continue to hold at 0.4%. So essentially zero, and maintain this deflationary story. Now, we just saw from the trade numbers that we continue to see since about the middle of the year deterioration in imports. That, of course, is that same demand story, or lack thereof, in the domestic market that then shows up in CPI that can't get very far away from zero for the better part of 2 years. And so as we look at this, the concern is that all of the optimism that we've now seen thanks to these export numbers in Chinese markets, in Chinese proxy assets, becomes something that unravels once this picture of domestic demand is in front of investors. Because indeed, if the upswell in external demand is temporary, then you need that domestic demand as the more lasting engine of expansion. And if that's not there, then it really is just a flash in the pan before the tariffs strike. As a matter of fact, if you look at the way that Chinese economic data has performed relative to expectations, this is data from Citigroup here, you find that it continues to trend toward underperformance, although it has narrowed a little bit back onto zero, suggesting that the expectations in the markets are getting to be about even with what reality is endorsing. Nevertheless, the bias still favoring softness. Moreover, we see that all of the expansive stimulus that China has unveiled is not working because most of it is monetary. And so we do not have the kind of demand that would be engendered by directly stimulating from the fiscal channel, from government spending, some sort of uptake in the economy. Instead, much of what Chinese authorities have done so far has been to lower borrowing costs by various ways to try to encourage people to buy, to try to encourage businesses to invest, to try to encourage local governments to make outlays. And what we find is that this Bloomberg Credit Impulse Index, which is a measure of new loans as a share of GDP, it is actually falling and has been falling since the beginning of the year. So this is plainly not working. In fact, if we look at the year on year, which is the yellow bars here, the rate of year on year change in this index, it's actually accelerating over the past 3 periods deeper into negative territory. So not only is credit easing not working, the situation is actually accelerating in the wrong direction. Of course, the precipitous running away of foreign capital from China does not help matters. At this point, we're looking at nearly a 30% year-on-year decline in foreign direct investment. Money is plainly running out of the country. And so what we're looking at here then is the kind of setup that might allow for an attractive trading opportunity betting against this recent optimism after the numbers that we saw this week. And while betting on Chinese equities themselves might be an unattractive idea because Beijing can effectively mandate those higher for no reason other than it say so, and copper might be a little bit of a challenging instrument because the futures contracts are a bit large and the ETF equivalents are not the most liquid things out there. The Australian dollar provides an attractive vehicle. We can see it too has surged over the past 24 hours and has in fact fared better against the dollar than, let's say, the euro or the pound in the wake of the election outcome. Both of those currencies suffered much deeper losses against the dollar. But now we're approaching some interesting resistance here near the 67 figure. If in the wake of the CPI data, we hit a wall right here and appear to be rounding out some kind of a near-term top, then an attractive selling opportunity back down into the sort of 66 area, plus or minus 20, 30 pips in each direction, this area right here, that starts to be an attractive target for a tactical short, if, of course, that topping here materializes. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I'm back with Chris for Futures Power Hour tomorrow, back with Victor and Tom for First Call on Sundays, again on Futures Power Hour Mondays, on the Price of Truth on Wednesdays, writing for the news and insights portion of tastylive.com, and commenting on the platform formerly known as Twitter at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.